Guys, so now that I got margin enabled on my account again, I wanted to show you guys something cool you can do with options to farm income with small accounts. Because when you sell puts, you need enough money to buy 100 shares, right? So like here in this example with the S&P, you would need $68,000 to buy 100 shares here, right? So that's not really, I mean, even if you did it, like say you went out a month, fucking daily options. Say you went out a month and you sold the 670 put, right? You get $500 in premium, but the trade would cost you $66,428 because you'd have to put 66 grand up as collateral and wait for that to play out. Well, you can do something called a put credit spread, which I'll show you how to do manually, and then also show you something cool you can do in Robinhood. But so say you want to do that same thing, like, something you can do, like you can do this daily on the S&P. And what's cool about that is the S&P after 10 a.m. is extremely unlikely to move 1% in any direction from that given point. Unless you get some super volatility like news, the S&P almost never moves more than 1% from where it's gotten to at 10 a.m. So you could take 1% of the price we're at now, which I don't know what that is. Let's see. Calculator. 683 times 0.01. All right, so $6. So 677 puts, right? Which should be roughly a 0.2 delta anyways. So if they expire Monday, 677, yeah, 0.18. So there you go. So you could sell this, right? And you're like, oh, I need 100 and enough money to buy 100. Well, check this out. So when you can do put credit spreads, so now you can actually go buy and then buy the put that's underneath it. Like you can really go as far down as you want. The farther you go, the more premium you'll get on the spread, but the more risk you take, right? So typically you just go one under. So right here, if we look at this, so as long as the price stays above 677, you're making $11 on $89, which I know that's a tiny amount of money. I understand that. And obviously, if you lose the trade, you're taking a fat loss, but I'll show you how to avoid that in a second. But, on $90 here, you're making 10 bucks. What is that? Like 12 to 15%? I don't feel like doing the math, but in one day, right? So you could just amp this up and you could do, 10 of these, right? And it would be 100 and 900, right? So $100 win, $900 loss. Now the only way that you would lose money is if the S&P fell underneath 677 by expiration, which this is November 3rd. So, I wouldn't do this, but I'm just trying to show you, like, you can do these daily, right? So say that it's November 3rd and it's after 10 a.m. and this is where we're at. You can take this trade and the probability of it hitting, below 677 is like it's under, shit, I don't know. Inside the same day, I think you'd have like a 4% chance of that happening. Basically, like the market would have to get some crazy news. But just like any other trade, you can set a stop loss. So what you do is you look at where your break even is, and that's where you set your stop. Like if the break even is hit, if the price of your break even is hit before the end of the day, you have to cut the trade. You cannot risk it because you can see how quickly it just absolutely zaps you if you go under there. So you would lose in that case like maybe $10 to $20, 30 tops, right? Like it's still less profit for the risk that you're taking, but the statistical chance of that risk happening is so low that these trades are worth taking. So this is called a put credit spread. And you can do this with a super tiny account. So you see this is a $670 stock, ETF, whatever, but the trade's only going to cost, in this case, $90 to make a profit of $10. And again, you could do 10 of these Now it's $100 and a $900 risk, and you could do 100, make $1,000 in a day, right? So you can do as much or as little as you want, but you stick to the rules of never risking. On trades like this, I would never do more than 1% of your account. So, I have 66 in here right now. 1% is roughly $600. So 5, 6, 7, yeah, right around there. So I can make $70 a day, no risk of assignment, put credit spread, and you can stop loss it just like you can anything else. So yeah, there's put credit spreads are really cool. And if you do that where you just wait to do it till after 10 o'clock, and then the position closes the same day with the S&P or IWM, because the options are 0 DTE. Like, you can literally trade options inside of the same day, and that theta works in your favor because you're selling options. So, the probability of you winning that trade is about 96%. Now, obviously, you don't make a lot of money for what you're risking, but you're almost guaranteed to make it, right? Like, this strategy has over a 96% win ratio. It's just like you have to manage it, because obviously if it does go against you, which again is very rare, but if it does, it can really fuck you. So you can't be super greedy with this. But you can do put credit spreads on anything. You can do them way out, right? So if you wanted to be safe and just like basically not risk anything at all, you could go out like a month on the S&P and just go sell puts and just go way, way down here. Like, okay, there's no way we're going back to, let's say 665 is probably 0.2. Let's go even lower. That's 0.2. You can go as safe as you want, right? So 650, 14% chance of hitting, right? So you could go all the way down here, and then you could buy, do the same thing, put credit spread. Here you're making $7 and you're risking $93. You just set it and forget it, right? And obviously you can, amp that up to 5. Okay, max profit 45, max loss 455. So you're making 10% on $455 investment in this case, right? Or you could do 50 and you make $450 on a $5,000 investment. Now, the reason that this isn't as good as just selling puts is because if you do get hit, like, you're just going to lose the money. And when you sell puts, like, you get assigned the shares. So even though you're underwater on the trade, like, as long as the shares recover, then you end up keeping the premium and you make money on the shares. So this is a more risky type of trading, in the sense that when you do take a loss, it's very hefty and can wipe out 3 or 4 wins. So I want you guys to understand that, like, there's a right and wrong time to do this. And personally, I like doing it on the S&P, because the S&P almost never moves more than 1% in a day, but it definitely, like, pretty much never moves more than 1% from where it is at 10 a.m. That almost never happens. And as long as you keep a pulse on the economic calendar, like, you have a pretty good idea of what type of news to expect for the day too. So like in October, I probably wouldn't be doing this a lot because October is volatile, right? But you get into a more stable month like November, or most of the months in the year, the summer especially, this is really, really safe to do. So I wanted to teach you guys all these option strategies a long time ago, but my account was locked up margin wise. So yeah, so that's put credit spreads. And then another way you can do it is by going to the builder, and you can just go down and select put credit spread, and then you just say, okay, price won't fall below, whatever. Just pick the right side is the lower leg of the trade. So you just pick here, boom. I'm going to show you same thing with this chart. As long as the S&P doesn't fall below 676, you make $8 and you're risking 92. That's over 10% again, or right there at 10%. So you don't have to build them manually. You can just use the builder here, but you also have other things you can do. So you have straddles and strangles, which I can teach you guys about in a different video if this is interesting to you guys. And then, which straddles and strangles are like when you're like earnings, right? Like if you're playing earnings and you know the stock's going to get a big move, but you're just not sure in which direction, you can play a strangle or a straddle, and as long as it gets a big move, you'll make money. Doesn't matter which way it goes, it just has to move a certain percentage. So strangles and straddles are really good for certain earnings events when you're expecting big, huge moves. Like Meta the other day would have been perfect for a strangle. Um, I didn't expect it to fall like that, but sometimes you just don't know. But sometimes you do know that a big move is coming because of some news or whatever. So yeah, those are pretty sweet. And then you have iron condors, which is where you could come and you could like you could sell this and then you could buy this put. So sell expensive, buy cheap, and then you go to the call side and do the same thing. I'm just picking random ones to show the example here. Okay, so then then that creates an iron condor. This is a really poorly built one. Like you'd want to give yourself more range on both sides. But basically, as long as the price stays between 681 and 688, in this example I just quickly built, you'll make $51 and your max risk is $47. So this is like a 50-50 bet, right? So on low volatility days, you can do iron condors on the S&P, and as long as the price stays within that range, then sorry, I'll call her back in a second. She's gonna be pissed, but as long as the price stays within that range, then you make your $51 and you don't lose anything. If price falls out here, then you take the max loss. So these are really cool option strategies because you have a predefined risk. You can just set it and forget it and like not look at it. I really like iron condors because it's even like 1-to-1 risk to reward basically. And with something like the S&P or really anything, any stocks that you follow regularly, the ranges pretty well, so you can build these condors like really strong, right? So like let's go to HIMS, right? So HIMS has a 42, yeah, it's up today. So HIMS has like a 42 floor and a 60 roof. So you could go out to like November and you could say like, hey, I don't think by the end of November that HIMS is going to be above 60, right? That's not right. These are puts. That's why I fucked up. All right, so calls, sell, boom, buy, boom. And then you could go, okay, I don't think it's going to go over 60. And then we go to puts. And then we go down and we go, I don't think it's going to go under 40. Let's do 39 to be safe. So sell the 39, buy the 38. This is a short iron condor. So you see in this case, we gave ourselves bigger range, right? So more probability of it being profitable, but we're taking more risk because of the larger range, right? So you can play around with this and you can look at this chart and see like how you want to build the trade, but there's a lot of like, again, I'm only risking $87 here in this scenario and I'm making $13, which is well over 10%. And you could just bump this up, right? So like, we do 10 of those. I'm making $400. Max loss of $610. Like it's just nice because these are statistically like really good trades, and if you know the asset you're trading, like you can basically almost guarantee yourself profit, and you can set stop losses on these just like anything else too. So anyways, I just wanted to teach you guys a few margins option strategies, and yeah, I'm currently not invested in anything because of the whole job situation, but yeah, just thought I'd show you guys that. Might start running the SPY daily put credit spreads just for some extra money. And those of you with small accounts, like that's something you can do literally every single day and build your account up pretty quick. So yeah, let me know if you have any questions. Pretty fun, cool little trick. All right, see ya.